the suits have arrived, accelerating institutional interest in crypto. The panel is led by the wonderful Eva Szalay, who is obviously a firm favorite of ours. She knows how to ask the right questions. Please welcome Eva Szalay to the stage.
May I invite my panel to please join me? We have Rupertus from BitMEX, Chief Commercial Officer.
Thank you.
Mike from BlockTower, a partner there, and Giovanni from CME. He is the global head of crypto products. Are the suits coming or going? Rupertus.
I'm not wearing a suit anymore. I gave up suits, but I know where your question comes from. There is, without any doubt, a tremendous evaluation and evolution into the crypto space, into the digital asset space from the institutional TradeFi world. I think it's fair to say this kind of business segment is not going away anymore. Technology will grow. Technology will sit deeper in the core banking systems of financial institutions. It's not going to go away anymore. The question is, how fast is the transition period, and what comes first, what comes second, what comes last. But I don't think it's going to go away anymore. And we see, hear, talk to several of these institutional clients. We know and understand what their needs are. And I think we're going to talk later on about what their needs exactly are. But I think there is a push into this business, yes.
Thank you. Mike, what do you think? Are they coming or going at the moment?
The types of suit changes. So, I don't know, restructuring bankers and lawyers and regulator suits are certainly coming right now. The institutional investment suits probably have taken a seat for a period of time, although they're not going away. They're just not necessarily, I'm talking about the suits are coming. The ones that are coming right now are the ones that are focused on restructuring the industry, which is a good thing. However, thankfully, we still have a lot of folks in t-shirts and cargo shorts building good products.
Giovanni, what do you think? I mean, you're almost wearing a suit.
Well, wearing a suit, the past couple of days I've been in jeans and turtlenecks, so I figured, today with the title, wear a suit, right? But I'd say, it's not so much that institutions are coming. I think institutions are already there. We launched Bitcoin futures just about 5 years ago, and we've seen a very diversified mix of participants in our space. We see the traditional proprietary trading firms providing liquidity, and those are firms that are trading, say, other CME products, trading out other markets as well. We also attracted, say, crypto-native platforms, some of the crypto-focused firms. But then beginning in the summer of 2020, we really started seeing those traditional macro hedge funds enter the space. We also started seeing some of the larger money managers begin to dip their toes. And then, we also see, retail interest in the space, particularly, say, with our micro contracts that we introduced last year. Now, when you look at what's happened in the market now, and there's been a lot of talk, say, about FTX and the fallout, there's this thought that there's a lack of confidence, a lack of trust in the space, and institutions are running for the door. But actually, we're seeing quite the opposite. I mean, we saw record volumes across our markets in November, post-FTX. I think November 9th, we traded over $6 billion in terms of notional on average for Bitcoin futures. We trade about $1.5 to $2 billion per day. So we saw excess volume that day. We also saw rise in open interest. A key signal that institutions aren't leaving, they're actually building positions, which is a healthy sign, for this market. Another indicator that shows that institutions are there is really when you look at the number of large open interest holders. That's a measure that our regulator, the CFTC, has, and they define that as any entity that holds at least 25 contracts, so 25 Bitcoin or 1,250 equivalent Ether. And that number reached a high of 439 such users on November 22nd, again indicating that participants are really coming to our markets to hedge risk or gain exposure during market-moving events.
One of the questions that I wanted to kind of delve a bit deeper into today was, who are these suits? And we'll have to stop saying suits. But who are these institutional players? Are they macro hedge funds only? Are they banks? Are they, asset managers? Can you guys give me a little flavor of how far that evolution has got to?
the least regulated, and I would consider a full bank being fully regulated. And then you have scaling down approaches, an asset manager and a family office. I would consider kind of an institutional investor already. Doesn't necessarily need to be fully licensed. So there are certain levels of wealthy pockets, I would call it. It is obvious that a fully regulated bank can only operate with fully regulated business partners. May it be a broker, may it be an exchange, may it be a custody provider. Regulated banks can only work with regulated companies. The lower regulation the investor has, the more freedom he can have in his selection of which exchange do I choose, which custody provider do I choose.
Do you see that changing at all?
I don't see that. I do see it changing, but it's not yet visible because I believe the banks, the classic banks, the Goldmans, the BNPs, the SocGens, and the Deutsches of the world, I would be blind to believe they're not engaging in the space. They're watching us 100%. They know exactly what we're doing. They see the wallets, they see the pies, they see the volumes, they see the revenue potential, and they see it's not going to go away anymore. The question is, up to what extent is an executive team of a financial institution willing to put their hands into the mud and start engaging into crypto, which is probably the biggest scare they have. If they would talk about custody solutions and they understand, oh, look, there is tokenization happening, there's NFTs happening, there is tokenization of stocks, bonds, ETFs, funds happening. Let's start with the lowest risk, reputational risk for a bank. Let's start with providing custody solutions for digital space. We can always say we are part of the game, we provide services.
We have the technology.
We have the technology, we're working on it, we're experimenting with it, but we're not doing crypto. Now, until you suddenly reach the degree where financial institutions, group heads are willing to go into crypto, is probably driven by the clients they have.
Yeah.
If the client's demand is there, at one point of time, the bank simply cannot neglect it and say, no, I'm not touching it. Because if you don't do it, someone else will do it. And we see this getting softer and softer, and I could name a dozen of banks now who are 100% sure, and I know it because I talk to the people.
You really should.
Yeah, exactly. What they are, where are they domiciled, under which umbrella. I mean, it's actually so funny. Sometimes these crypto initiatives within the bank are covered under the FX trading desk because they do not want to be seen as having a dedicated crypto desk in the company. Yeah. So the perception of reputational risk is still massive in the space. And that's why I believe it's coming. They're working on it. And crypto is definitely on the agenda, but it's not yet that visible.
Thank you. Mike or Giovanni, do you have any thoughts on that?
Yeah, if I could add to that, certainly, when we launched Bitcoin futures, the banks were there, but really kind of on the periphery. They were only, say, providing clearing access for certain clients, but their doors really weren't open. But that has started to shift, and to your point, really driven, say, by that institutional hedge fund, in particular, demand. So now we're seeing banks, the doors have opened up a little bit more. We're seeing additional participants come in on a clearing perspective, so providing, say, services for their clients. But we're also now beginning to see banks begin to actively trade. As some of these banks, some of whom you mentioned, begin, say, to start their own OTC desk, providing, say, structured products. They're coming to our markets now to hedge some of those products.
Yeah, I would say there's building blocks. So in 2017, we co-authored the CBOE futures white paper. I don't think you guys invited us to co-author yours.
How did that go?
It didn't go so well. In theory, it's fantastic. But that created the building blocks for what became the first ETFs in the business. It also became the building blocks for, large hedge funds that are fiduciaries and invest on behalf of investors that are not prop desks to trade in this market, right? To do whether it be relative value trading or otherwise. So there's kind of steps in the process. So the suits are coming. If you think about it in reverse, the most recent suits are special situations funds that are buying, FTX claims. Then you've got the restructuring and bankruptcy advisory and legal firms who are working through a lot of these large-scale bankruptcies currently. So there's a lot of organizations, institutions, suits that are currently forced to or find economic value in underwriting the industry. It's kind of digging through a lot of the dirt, but they're understanding and learning more along the way. Before that, it was, the banks, the investment banks. So I think Goldman just announced a few days ago the launch of their DAP platform, which is where they're going to be, they've issued a $100 million Euro bond, and they'll plan on doing more across the board. Matt McDermott's running a very large team there in London. It's a global team, but they just increased their headcount, 2x in the last year. And as a former GS employee, unless you're making money or saving money, you're not getting headcount. So, and then beyond that, I think from an LP standpoint, from an investor standpoint, we've seen that progression over the years, and kind of who are they? They're, the large-scale U.S. pensions. They're, the general accounts of insurance firms. There's traditional money managers, endowments, foundations, and the like. So, they're there. They're going to re-underwrite the space. If you liked it at 100, you love it at 50. But I think ultimately suits are here. New ones are coming. New ones will continue to come. Generally, it's a net positive. We've been through a couple cycles now, and every time we come out of one of these, it's usually for a better result.
I would say the biggest liquidity providers and market makers in the space. I mean, Giovanni was one of them. Wintermute, Tower Research, Jump, Flow Traders, you name them. Those guys who used to be super active, high frequency trading, algo trading driven companies, being in the traditional finance world, arbitraging stocks, arbitraging bonds, arbitraging equity, ETFs versus structured products versus equity, backwards and forwards. They're all in the crypto space. And guess what? All of these supersized market makers and liquidity providers, they need a banker as well, because most of them are not fully licensed banks. So they are engaging with their prime broker banks, JP Morgan, Citibank, you know them all. Another reason why these banks simply cannot say it doesn't happen. I mean, these market makers are looking for capital efficiency. They're going to borrow here, they're going to lend here, they're going to take cash here, they're going to invest it here. For them, if it says euro, dollar, or Bitcoin, it's completely irrelevant. Yeah. It's simply another term that provides some kind of liquidity and a bit of a spread, and coincidentally interest from clients who want to own it. But the market maker couldn't care less what his computer is computing as a bid and offer spread. And this all flows into the big pot of risk capital managed by a banker saying, okay, I allocate you this, I allocate you that. So this is why they can't say, I'm not part of the game anymore.
You mentioned risk. Any risk managers coming?
I mean, FTX should have had some. It's a bit unfortunate. Unfortunately, it's a bit too late to ask that question. I think I was attending a blockchain conference in Barcelona last year in spring, and my former CEO of Six Digital Exchange, Tim Grant, now with Galaxy, opened the podium. And he said to the audience, 800 people sitting on the Monday morning, 8 o'clock, and the guy says, opens the panel and says, I'm afraid to say, by the end of this year, 90% of you will not be around anymore. That was his opening speech. Meaning, most of you guys have no capital, no business model, no risk control functions, nothing that is a valid business case. And unfortunately, we had to go through this disaster of dropping market value in the crypto space, companies going bust, belly up, because of an inappropriate risk management, because of an inappropriate business model, because of an inappropriate behavior versus investors, funds, proprietary investments. Of course, it needs more risk control people. And this is the thing why suddenly this hybrid space, like myself, being 20 years in traditional finance and now a couple of years in the business of crypto and digital assets, has a value, because I've seen this all before. We are currently in a phase where we are in the dot-com in 2003, where suddenly out of the blue, $1 billion unicorns did an IPO on the German stock exchange, and 6 weeks later they were bankrupt. And people were asking themselves, how could that happen? And the same happens now. So it's kind of a cleaning storm that should clear the sky, and who survives now and who has a business model and risk measurements and risk control and a business plan should survive and become stronger than they were before.
Yeah, I mean, risk management is ultimately up to the organization or the individual. Outside of that, regulation will manage I don't know, existential risk for an industry on the institutional side, and consumer protection regulation will protect consumers. I mean, you can't expect every individual in the world to know that giving, one of the centralized lending desks, BlockFi, for example, your Bitcoin earning 7%, you should be thinking of that as an unsecured loan to a venture-backed company. Like, your required rate of return is not 7%. It's significantly higher, but consumers aren't aware of that because it's being marketed as a savings account. And so I think consumer protection ultimately will be probably one of the driving forces for risk management that impacts the broad retail base, which is much more meaningful from a industry perception context.
Yeah.
From an institutional standpoint, I mean, it's just, it's going to be continued regulation of our markets and our industry. So you guys have done a great job with that. So I'll pass it to you. Why not?
Thank you. So when we look at our markets, right, our system of having, say, FCMs, right, and we've got futures commission merchants. We've got about 30 or so FCMs supporting our crypto products. And when you look at those firms are there, say, to help market participants essentially, say, manage that risk and socialize that risk among that network of 30 or so firms. They also provide, say, inline credit controls really to help their clients, say, or manage, say, that client risk. Additionally, at the exchange, we offer other risk management measures. We have allow, say, or our markets look to track, say, actual traded activity. So we monitor how quickly price moves. So if market is moving, say, too fast, too quickly, we have mechanisms in place to slow the market down. We have position and price limits in place. So if the price gaps by too much, we institute temporary halts, allowing the market to collectively catch its breath. We reopen the market where everybody's now on a more, say, level playing field. And we also have position limits in place to control, say, anybody from looking, say, to have too large a position that may become, say, unmanageable.
Thank you. And just before we kind of leave the whole risk arena, what do you guys think, Rupertus, you were talking about, banks and the reputational hazards. This whole cleansing exercise, what happened in this past year, how does that impact that appetite, do you think? And, let's face it, if you read the newspapers, you would think that this whole space is pretty much dead. So, can you tell me your headline thoughts on, the reputational risk and how that kind of translates into action?
Unfortunately, I believe there's still a tremendous amount of money locked up with FTX, and a couple of market participants who do have a good business model were supposed to be funded adequately. Now, unfortunately, can't access into their funds, so there seems to be a new rush of the fresh funds in order to continue your business model. We at BitMEX see an increasing demand from market makers and liquidity providers who used to do a lot more activity at FTX, and now they come to us. BitMEX is a bit of a, if I may say so, it's a bit of a boring exchange. We are a one-trick pony. We are the inventor of the perpetual swap and the Bitcoin futures. We are derivatives by DNA, and people who like to be more in cash and carry arbitrage, spot trading, market making, derivatives, creating structured products. It's not really our clientele. We want the pure derivative leverage fence. And suddenly people come back to us because we've been around for quite some time. We are super funded. Our tech is robust. There's never been a Satoshi being gone missing in our world. So suddenly people do recognize not everything that looks super fancy must necessarily be the best business model and the business provider and platform. On the other side, you can never prevent fraud. Unfortunately, your risk system can be as good as it may be. Your system can be as robust as it can be. If you are working with simply criminal-minded people, you can't avoid it. That happens in Wirecard Bank in Germany. It happens in Enron. It happens with Madoff. It happens with many, many cases. Look back in the history of finance, and you'll see always disasters where individuals were simply criminals, and you can't, it's difficult to protect you from criminal offenses. So Other than that, everything else is moving in the right direction. And I think, yes, it dips, and the messages, of course, the headlines in the press and in the media are not that sexy to read these days. But as I said, I don't think the business is going to go away. It's the question of when does the Bitcoin move out of his range trading between 16,000 and 17,500, when does it break out to 20,000, and then it's going to go the next way. Investors, the retail mass who's driving the prices, they are waiting for the next breakout level. And then in 6 months' time, believe me, nobody's going to talk about FTX anymore.
I will write this down. Mike, what do you think?
Yeah, I mean, unfortunately, growth tends to come from people who move quickly and operate in the outer bands of what's right. So looking back, it's great to have bad actors out of the industry. It's not necessarily de-risking the industry, because I don't think anyone here or anyone in the investment space wants one exchange to have 80% of the market volume. That's just not a functioning, it's not a well-functioning, not a healthy market. So the nice part is there's a lot of folks who are building more slowly, steadily towards a more balanced operation where, you know, that may come up in the next, 3 to 5 years, and we have, great properly institutional in terms of risk management operations, regulated exchanges that can provide, the type of liquidity a healthy market will generally operate in. So I think, cleansing events are good. I wouldn't take this as a it's good for the washout, but there is implicit inherent risk in the market right now, and it's probably more concentrated than it ever has been, which provides new levels of risk or new types of risk.
Such as?
I mean, just like I just said, we have 80% of the market right now trading on effectively one exchange that, seems to be doing the right things currently, and hopefully they are. And
so concentration risk is what
concentration risk, which and again, it's market pricing is based on healthy exchange of a bid offer. It's hard to feel confident in market depth, market pricing when you have such concentration. And the market participants, that's also consolidated quite a bit. So I think these are necessary evils that need to happen where you have this washout, but in the depths of that washout, you have increased risk in the form of a potentially mispriced market. So to your point, I actually very much of the mindset, once risk assets trough and there's confirmation of that, investment, memory is short, and you probably have 6 to 12 months before, I wouldn't say before price moves, before there's enough market depth to have real, people deploying real capital into this space. So, I think that's the key thing to be aware of.
I think one of the things that was interesting, right, when just before the FTX fallout, Bitcoin volatility, based on our futures contracts, was near 2-year lows. We saw like a very sharp spike post FTX, but by the end of December, volatility was trending back down, and currently is back down to 2-year lows, right? So the marketplace has been able to absorb, say, not just FTX, but some of the other failures earlier in the year. And I think as has been pointed out on other panels, this has really been more about bad actors, lack of risk management, but really not a reflection, say, on cryptocurrencies. And in fact, Bitcoin, there was a panelist yesterday who said the second best time to buy is now. And today, I think the price of Bitcoin is up 3.5% over 18,000 now, right? So
the whole of St. Moritz is buying. Okay, thank you. So isn't it a little bit ironic that we're talking about concentration risk in this, world of decentralized everything? How do I get my head around that? Help me.
Yeah, it makes a great case for building any decentralized exchanges and decentralized, capital market system. At least in our world, it seems to make a lot more sense than centralized. But I do think that the next run will still be a centralized based, rally, and I think it will be a relatively I think we have probably one more cycle that is relatively unregulated. And I think in that type of market, centralized operations can act more swiftly. But I think over the next 5 to 10 years, investing in the decentralized market structure space is important. Yeah, so I mean, and there's a bunch of different, like we're talking about, trading markets specifically, right? There's a whole swath of things happening in the world of consumer and what people bucket under kind of Web3 and the economies of intellectual property. But even things, like we're one of the newest things we did was launch a credit fund, and we're bringing, traditional secondary market structured credit clips on chain, securitizing them on chain, junior, senior tranche, getting the senior, finance that through a facility we voted on with the global maker community. And that is probably 40%. Now it's an up and running fund, but it's probably 40% of where we want that to be in terms of the operational process. So done a lot building the pipes. I think eventually a fully on-chain credit fund is a possibility. It's going to take a lot of work and a lot of effort. And when you're going after these very large markets, I think people need to work together to get there. And unfortunately, some of the less sexy stuff that has an enormous TAM, like the global credit market is one of the largest in the world, but it's not sort of that, that quick hit of dopamine, yield farming, recent DEX or some NFT mint, right? It's something that requires, this is, just to get it up and running was 9 months of dedicated work from a team of 5, which doesn't sound like a lot, but in crypto, as investment management, it's a big team. And you have to basically roadshow communities to get the governance votes, to get these things pushed through. And you're really just a good actor trying to, one, take advantage of an arbitrage between traditional credit, cost of credit and crypto cost of credit, but also, you're trying to make it a healthier market. So you want crypto balance sheets to have exposure to traditional structured credit, right? You want them not to be this circular reference of its own industry. That is how you eventually bridge traditional markets and digital markets. So I think that the fungibility of digital and traditional markets is very important. So those are the types of things that I think hopefully people will focus on, in the background. That might require more suits just because the credit markets tend to have more suits. But as of right now, it's still an on-chain, off-chain process. It requires 2 parallel tracks, which requires, incremental cost, but eventually down the line, the cost saving, time saving. That's the kind of stuff that I think is interesting. Sorry, I spoke a lot.
No, that's very interesting. Thank you.
If I may add, I couldn't agree more with what Mike just said. Remember, the crypto space was let's say the centralized exchanges for crypto is the first step born from an idea to disconnect my personal wealth from my banker at home in doing my own financial means, doing my own trading, carve out the intermediate, pay less fees, being in charge of my own destiny, creating trust. I trust the chain more than I trust my private banker. That's where we come from. Now, this is all a bit coming into a shaky situation, but this is a step. And Mike just mentioned the sheer dimension of markets. Crypto is tiny, still is super, super tiny. We are a niche market, like a drop in the ocean. Now, this adaptation in making it large, sizable, scalable, it's going to take years. And it's not going to be driven by crypto only. It's going to be driven by technology. It's going to be driven by tokenization of assets as such, and crypto being part of the payment facilities for such assets. If not, CBDCs, as we heard yesterday, are taking over, and stablecoins are paying for it all. But these coins and tokens acting as a facilitator in order to go for the big picture. And this is going to take years. And that's why I believe, consider the fact, this is a bunch in a forum of highly professional people in the space. Talk to somebody who normally goes to his banker and asks for a 5-year government bond to do his investment strategy. He hasn't got an idea what crypto is and how to open a wallet and to which broker do I use, on which exchange do I execute my order. We are far away from reality. Yeah, we are flying high. So bringing this, and now imagine you tell them, you know what, there's even something more sexy. We don't call it centralized exchange, we call it decentralized exchange. And it's much more fragmented and much more crazy and diversified. And people say, okay, I'll go back to my banker. Yeah, they just lose.
It's too scary, it's too much.
It's too scary. So that's why I believe the adoption period until our business will be, in the meanwhile, consider as our bread and butter business, normal day-to-day job, it's going to take a couple of years until this becomes mainstream.
We have 3 minutes, so if you don't mind, Giovanni, I'm just going to come to you with the last question. Is crypto going to be Wall Street 2.0?
I'm sorry, repeat that question?
Is crypto going to be Wall Street 2.0?
Good question. And just to touch a bit on your point, when we look at the crypto market, it is, say, relatively small. And just to put that in perspective, on average, we trade 1.5 to 2 billion on Bitcoin per day, about 700 to 800 million on Ether. Comparing that, say, to gold, we're trading about 40 billion a day in gold futures. Looking at S&P 500, we're trading about 400 billion per day on that. So in terms of growth, there is like a huge path there. But I do think that longer term, as you see, say, we've moved away, say, from people being interested in Bitcoin for speculative purposes or crypto for speculative reasons, but it's really about the use cases. And as we see, say, more use cases, as we see more time pass with Bitcoin and Ether taking the lead, it starts developing. Those two coins become, say, more. They're going to provide, say, more legitimacy in the space. It's going to draw, say, more institutions. And I think to get that further growth, it's really about attracting more institutional adoption. And I think that is happening, although we are still at very early stages of that development.
Just one point. Gold doesn't have that many users. And still there's a huge market, like you mentioned.
Yeah, but when you say it doesn't have that many users, you said?
Use cases, sorry. Yeah, you mentioned, use cases as being very relevant for the crypto industry, but, the size of the market, the gold market, was an example that you used for the crypto in the future. So is the use case point really relevant?
Drawing on the parallels of folk thinking about Bitcoin, say, as a store of value, and gold, say, serving that purpose now, just to put in perspective, say, where Bitcoin could grow, particularly, say, compared, say, to gold.
Okay, and is it going to be Wall Street 2.0? Yes or no?
I'd say yes.
Mike?
Wall Street's financing and advisory, I would say, on the market structure side, yes. On the advisory side, possibly. I think it's Wall Street 1.5. I think it's FinTech 1.0, because FinTech is really just financial models, new means of financialization of assets, and I think that's probably the bigger moat for what crypto is doing. So I call it FinTech 2.0, Wall Street 1.5.
I like that. Rupertus, your final point?
My guess would be, tech-wise, is Wall Street 2.0, yes.
Great. On that point, with 10 seconds to spare, we will say goodbye. Thank you so much.
Thank you.